Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to the Deep Dive. Today we're going deep on M&A.
Mergers and acquisition.
Exactly. Specifically for businesses like yours in that $2 to $50 million range.
Right.
You sent over this Deloitte report.
Oh, yeah. M&A. Making the deal work. It's a good one.
It's got some really great stuff in it, and we're going to try to pull out the golden nuggets from this report that will be most helpful to you.
Absolutely.
So one of the things that I thought was really interesting is this idea, and it kind of threw me for a loop when I first read it, that economic downturns can actually be a prime time to make acquisitions.
Yeah, it's counterintuitive.
It is counterintuitive.
You would think.
Yeah. Hunker down.
Batten down the hatches.
Exactly. But no, actually, it's a great time to buy because you can buy for value.
Buy for value.
When everyone's panicking and the market's down, asset prices drop.
Right.
That includes the price of companies.
Yeah, so it's like Black Friday.
It is. It's exactly like Black Friday for businesses. Okay, I'm liking this already.
Yeah, and there's an index that Deloitte uses called the Acquisition Price Index, or the API. And this is a normalized acquisition premium that's paid for a deal.
Got it.
And so what we're looking at is not just, the raw price, but we're also looking at the premium that you typically pay during an acquisition.
Okay.
And how that changes when you're in a downturn.
Okay, so give me an example.
Okay, so let's say you want to buy a company, and in a good market, that company is going to cost you $10 million.
Okay.
And you're looking at a premium of, let's say, 20% on top of that price tag.
Okay.
So that brings you to $12 million.
$12 million, okay.
Now we enter into a downturn. The market values are lower.
Right.
And so now that premium is going to go down.
Right.
Let's say it goes down to 10%.
Okay.
Now you're only paying $11 million for that same company.
So I've saved $1 million just by
waiting for the right time.
Wow. Okay. And then on top of that, the report also talked about how financing is more favorable during a downturn.
Exactly. Because the Fed typically lowers interest rates during a downturn to try to stimulate the economy.
Okay.
So what that means is if you're taking out a loan to finance this acquisition, your interest rate's going to be lower.
Okay. So how much lower are we talking? Like, give me a for instance.
So over the past 9 recessions, the effective Fed funds rate has decreased by an average of 390 basis points.
Okay, that sounds like a lot, but I don't even know what that means in real terms.
So let's say before the downturn, interest rates are 7%.
Okay.
That 390 basis points could bring it down to like 3.1%.
Okay, that is significant.
Very significant, yeah.
Wow. Okay, so we're talking lower acquisition, cost cheaper financing. This really does make downturns look a little bit different.
It does, but that doesn't mean just go out and buy any company.
Right.
You have to be what the report calls an advantaged acquirer.
Oh, I like this.
Yeah.
Okay, advantaged acquirer. Yeah. So break that down for me. What are the signs of an advantaged acquirer? What should we be thinking about?
Well, the first thing is self-awareness. They know their strengths and their weaknesses.
Of their own business. Got it.
And so they know what a potential acquisition could really do for them. So they're not just going for any shiny deal.
Right. They're being strategic.
Yeah, very strategic.
Not just opportunistic.
Exactly. And the second thing is they have identified priority pathways.
Okay.
So they have an M&A strategy that's very clear and aligned with their business unit and their corporate growth plans.
Okay.
So they know what to buy just as much as when to buy.
So kind of going back to that shopping list analogy.
Right. Oh.
You go in, you know what you need.
Yes.
You're not just going to buy everything on the shelves.
Exactly. You're not just walking up and down the aisles going, ooh, that looks good.
Right, exactly.
Okay.
Okay, so we've got self-awareness, we've got identified priority pathways.
Now, the third thing is really interesting. It's competitor signaling.
Okay.
So they're actually looking at what their competitors are doing in the M&A space.
Okay.
So they're analyzing those deals to get a sense of their strategy and maybe even anticipate what their next targets are going to be.
Oh, so it's like a chess game.
It is like chess.
Yeah.
You're trying to anticipate what your opponent's next move is going to be.
I like that. Okay, so that's competitor signaling.
And then the fourth thing is strategic screening.
Okay.
So they're not just chasing after every company that looks interesting. They have filters. And these filters could be things like size, geography, customer segment.
Okay.
So they're really narrowing down their list to the targets that make the most sense.
So it's like finding that puzzle piece that fits perfectly
exactly
into their existing business.
Yes. And then the final thing is disciplined execution.
Okay.
They're thinking about integration right from the beginning.
Makes sense, because integration seems to be where it all falls apart.
A lot of times, yeah. So they're asking themselves, do we have the resources, the talent, the organizational capacity to actually make this work?
Okay, so we've got our two big takeaways here.
Right.
Economic downturns can be a prime time to acquire.
Yes.
But you need to be an advantaged acquirer.
Exactly.
To make it work. And you've given us 5 characteristics of that advantaged acquirer.
Right.
Now, one thing I'm still curious about is this whole due diligence process.
Right.
You mentioned that advantaged acquirers have a watch list. They do their due diligence. So talk to me about that. What are they looking at? What are the red flags? What should they be aware of?
Well, that's a great question, and it leads us right into our next key takeaway.
Okay.
Which is that due diligence should go beyond just the financials.
Well, I would think the financials are the most important thing, right?
They're very important.
Yeah.
But a lot of companies get so fixated on the financials that they neglect the operational side.
Okay.
And this is where we get into what Deloitte calls synergy capture diligence.
Synergy capture diligence?
Yeah.
Okay, I'm intrigued. Break that down.
So it's a bottom-up approach that analyzes potential cost reductions in detail, and it gets management buy-in from the beginning.
So you're not just looking at the financials.
Yeah,
you're actually digging into the nuts and bolts of how these two companies would operate together.
Exactly.
Okay.
And how those cost efficiencies would actually be achieved.
Okay, so it's about being really granular.
Very granular.
Got it.
The report outlines 5 key steps.
5 key steps.
Okay, let's hear them.
So step 1, you create consistent cost and functional baselines.
Okay.
So you're gathering detailed P&L data from both companies.
Profit and loss.
Yes. And you're normalizing those statements to get a clear picture of the combined financial landscape.
So you're making sure that you're comparing apples to apples.
Exactly. Step 2 is to segment and prioritize synergy opportunities.
Okay.
So you're starting to identify those areas where you think you can achieve some cost savings.
Got it.
And Deloitte suggests dividing these into 2 phases.
Okay.
Phase 1 is for quick wins.
And phase 2 is for synergies that might require a little bit more investigation or a longer-term planning horizon.
So you're already thinking about the timeline.
Yes, exactly. Step 3 is where it gets really interesting.
Oh.
You're quantifying those synergy opportunities and the cost to achieve them.
Got it.
So this involves detailed interviews with executives and functional leaders from both companies.
So you're not just making assumptions based on spreadsheets.
No, you're talking to the people who are actually going to be responsible for implementing these changes.
Smart.
So you're getting their input, their buy-in, and their realistic assessment of what's actually achievable.
Okay, that makes sense.
Step 4 is to develop a new financial model based on all this information and explain any variances from your initial assumptions.
Got it. So you're revising your projections.
Exactly.
Based on these insights.
And then the final step 5 is to create a synergy capture enterprise blueprint and integration roadmap.
Okay, so you're literally creating a roadmap.
Yes, this is a detailed plan for how the combined organization is going to operate.
Got it.
Outlining the milestones, the dependencies, the potential bottlenecks along the way.
This is really interesting because it sounds like a lot of times companies kind of go into these acquisitions with blinders on and hope for the best, and then it all falls apart.
Exactly. And that's where this synergy capture diligence can really make a difference.
Right, because you're thinking through all of these potential issues up front.
Exactly.
And creating a plan to address them.
It minimizes those post-merger surprises.
The report gave a couple of real-world examples of this in action, right?
I did.
Do you remember any off the top of your head?
Yeah, one example was a regional utilities company.
Okay.
And they were considering a major acquisition. And through this bottom-up analysis, they were able to identify 50% more incremental synergies than their initial top-down estimate.
Wow.
Yeah. So They significantly underestimated their cost-saving potential until they went through this granular diligence process.
Wow. Okay. So they left a lot of money on the table.
Essentially, yes.
By not doing this kind of diligence.
Yeah.
Were there any other examples?
Yeah, there was a life sciences company that was acquiring a target twice their size.
Wow. Okay.
And by engaging in synergy capture diligence, they uncovered $150 million more.
$150 million?
In incremental synergies.
Wow.
Yeah, and they were able to front load a significant portion of those synergy captures into the first year.
Okay, so they got their return on investment a lot faster.
Much faster, yeah.
It just makes me think of that analogy.
Mm-hmm.
You know, if you're building a house,
right.
You know, you focus on the foundation, the financials,
right,
but you forget about the framing, the plumbing, the wiring, all the operational stuff.
You're going to end up with a structure that's not ready to live in.
Yeah, exactly.
It's a great analogy.
Yeah, so I think that's a really important point for our listeners. Don't be afraid to dig deeper. Challenge Telator. Those high-level assumptions get granular with the operational details and make sure you're building a deal on a foundation of realistic synergy capture.
Absolutely.
Now, speaking of challenging assumptions, the report also had some interesting insights about the psychology of deal-making during downturns.
Yes, downturns can actually create a more favorable environment for buyers.
Okay, now this is getting really interesting.
Yeah, because there's a lot of uncertainty and fear in the market.
Right.
Sellers are often more motivated to strike a deal because they're worried about their future prospects. They might be facing financial pressure, declining sales, increased competition.
So they might be more receptive to an offer.
Yes, even if that offer is lower than what they might have commanded in a booming market.
So it shifts the bargaining power to the buyer.
Exactly.
Okay.
Deloitte uses the analogy of a clearance sale.
Oh, I love this. Okay, so just like shoppers wait for those end-of-season sales to get the best deals.
Exactly.
Savvy acquirers should be looking for those clearance sale opportunities in the M&A market.
Exactly. You're recognizing that market psychology plays a huge role in deal-making, and downturns can create a psychological environment that favors the buyer.
Okay, so not only are prices lower and financing is cheaper, but sellers are also more motivated to make a deal.
Yes. It's a triple whammy of advantages for the buyer.
I like that, the triple whammy. Okay, but it's not about abandoning your strategy.
Yeah.
It's about adapting your strategy to the market conditions.
Exactly.
Now, the report actually backs us up with some data too, right?
Yes. They looked at the acquisition price index, which, as we discussed earlier, represents that normalized acquisition premium paid for a deal.
Right.
And what they found is that during downturns, this API tends to drop significantly.
Okay.
So, for example, during the 2001 recession, it dropped more than 10%.
Yeah.
And during the Great Depression in the 1930s, it dropped more than 30% below its peak.
30%?
Yeah.
That's a huge discount.
It is a huge discount.
Wow. Okay, so the data clearly supports this idea that downturns can be a buyer's market in the M&A space.
Absolutely. And they also looked at the stock market performance of companies that made major acquisitions during the 2001 and the 2009 recessions.
Okay, so these are the companies that went against the grain.
Yeah.
They said, we're going to
buy
when everybody else is hunkering down.
Exactly.
So what happened to those companies?
Well, they found that many of those companies actually outperformed the S&P 500 index over the same period.
Really?
Yeah. So the market actually rewarded those companies that had the foresight and the courage to make acquisitions during those difficult times.
That's really interesting.
Yeah.
Okay, so we've got the data to back it up. Downturns can be a prime time to acquire.
Yes.
But you need to be strategic and disciplined in your approach.
Absolutely.
Sensing a theme here.
Yeah.
Now, to illustrate this point, the report actually dives into some specific examples of how companies across different industries have successfully capitalized on downturns through M&A.
Yes. They highlight 3 industries in particular: mining, automotive, and industrial products.
Okay.
And in each case, they showcase how companies have used M&A to not just survive downturns, but to thrive and emerge even stronger.
Okay, well, let's start with mining.
Okay.
What's the story there? What happened?
So the mining industry is very cyclical.
Right.
It's heavily influenced by global commodity prices,
Uh-huh.
which tend to fluctuate
They do.
wildly. And in recent years, we've seen a significant downturn in the mining sector,
Okay.
driven by factors like weaker global demand, particularly from China, and stricter environmental regulations.
Right. So this downturn created a challenging environment for mining companies.
It did, especially the smaller players who might not have the same financial resources or operational flexibility as the larger ones.
So how did M&A play into this?
Well, this downturn created a window of opportunity for the larger cash-rich mining companies to acquire those struggling smaller players at a discount.
So it's survival of the fittest.
It is a bit of a survival of the fittest scenario.
Right. The strong get stronger.
Exactly. And they're consolidating the industry and positioning themselves for future growth.
When the market recovers.
Exactly.
What kind of specific examples did the report mention?
So they pointed to the trend of larger mining companies acquiring smaller ones that are struggling to stay profitable as commodity prices fall. They also highlighted how some mining equipment manufacturers are forming alliances with suppliers to offer a full portfolio of parts and services to their customers globally.
So they're leveraging their scale and their relationships.
Exactly, to provide a more comprehensive and competitive offering.
Got it. Okay. So it's a mix of acquisitions and strategic partnerships.
Yes.
All aimed at kind of consolidating their positions and expanding their reach.
Exactly.
Okay, what about the automotive industry?
So the automotive industry has been experiencing a period of tremendous growth and profitability in recent years. But
a decade ago.
A decade ago, during the 2008-2009 financial crisis, the automotive industry was in a state of paralysis.
Right.
Many companies were forced to make drastic cuts, and some even faced bankruptcy.
Yeah, it was a really tough time for the industry.
It was.
So how did they come back so strongly?
Well, M&A definitely played a role.
Okay.
The report highlights how many automotive suppliers and OEMs,
original equipment manufacturers.
Yes, that had aggressively cut costs during the downturn, actually started consolidating to bolster their competitive advantages and leverage global platforms. So economies of scale and global leadership have become key drivers of merger and divestiture activity among auto suppliers.
Okay, so they used M&A to streamline their operations.
Yes.
Gain efficiencies and expand their reach.
Exactly, and it's not just about acquiring companies.
Right.
It's also about divesting underperforming or non-core businesses.
To focus on areas with the most growth potential.
So they're really getting lean and mean.
Exactly.
And focusing on what they do best.
Right.
Okay, so what about the industrial products sector?
So industrial products companies have also been facing a lot of pressure in recent years. Driven by factors like cost-cutting measures and slow global growth. The report highlights how some industrial products companies have been pursuing deals in high-growth sectors like alternative energy to diversify their portfolios and tap into new markets.
So if your core business is struggling, you got to look for opportunities in areas that are growing.
Exactly. They've also been consolidating to take advantage of economies of scale and reduce costs.
Right.
This is especially true for heavy equipment manufacturers who are facing intense competition from global players.
So again, they're using M&A to kind of streamline their operations, become more efficient, and strengthen their position in the market. Exactly. And they're also pursuing innovations like next-generation underground mining equipment through joint ventures and alliances.
Interesting.
So this allows them to share the risks and costs of development while also accessing new technologies and expertise.
So we've seen how companies in these three very different industries, mining, automotive, and industrial products, have all used M&A to navigate downturns and emerge stronger.
Yes.
And I think there's a real opportunity for businesses in that $2 to $50 million range.
Absolutely.
To apply these same principles.
Yes, and to guide businesses like yours.
The
report actually outlines a framework for capturing value in downturns through both inorganic and organic growth strategies.
Interesting. Intrigued. Tell me more about this framework.
It's called the Fuel for Growth framework.
Fuel for growth.
Yes, and it's a three-step approach that focuses on optimizing your portfolio, disciplining your spending, and reinvesting capital in new growth targets.
All right, so step one is optimize your portfolio.
Yes.
What does that mean?
So you're divesting non-performing assets.
Okay, so you're getting rid of the dead weight.
Exactly. You're freeing up capital to invest in more promising areas.
So it's like pruning a tree. You're cutting away those dead branches to let the healthy ones flourish.
Love that analogy, yeah.
So how do you actually identify those dead branches in your business?
Well, the report suggests conducting what they call a profitability baseline and fixed cell analysis.
Okay, profitability baseline.
Yes.
Fixed cell analysis.
Yes.
What is that?
So you're identifying those underperforming assets.
Okay.
And you're determining the best course of action.
Got it.
Do you fix it? Do you sell it?
Okay.
And this analysis helps you objectively assess the financial health of each business unit and make data-driven decisions about which ones to keep, which ones to improve, and which ones to let go of.
So step one, take a hard look in the mirror.
Yes.
Make some tough decisions about where to allocate your resources.
Yeah.
Step two is discipline your spending and costs.
Yes, in your remaining portfolio to increase asset productivity.
Okay, so this is about becoming more efficient.
More efficient.
With your resources.
And finding ways to do more with less.
Okay, so you're tightening your belt.
Tightening your belt.
Cutting unnecessary expenses.
Yes.
Streamlining your operations to squeeze more value out of your existing assets.
Exactly.
Okay, so step two is all about getting lean and mean.
Lean and mean.
And then step three.
Step three, you're reinvesting the capital.
Okay.
That you freed up from steps 1 and 2.
Got it.
Into new growth targets, leveraging the lower prices typically seen during a downturn.
Okay, so you're taking all that hard-earned money.
Yes.
And you're using it to acquire new businesses or invest in new opportunities that can drive future growth.
Exactly. And remember, downturns can be a particularly good time to do this because asset prices are typically lower.
Right. You get more bang for your buck.
Exactly.
Now, we've been talking a lot about inorganic growth through acquisitions.
Right.
But the report also mentions organic growth strategies.
Right. Absolutely. Organic growth, which involves expanding your existing business operations, can also be a powerful way to capture value during downturns.
Okay, so give me some examples.
So, for example, the report highlights how manufacturing OEMs and suppliers can take advantage of recent market consolidation to offer existing customers a global one-stop shop value proposition.
Interesting.
That contrasts with smaller players who have limited offerings and a regional geographic presence.
So you're leveraging your scale, your relationships, and your existing capabilities to provide a more comprehensive and competitive offering to your customers.
Exactly.
Okay, so that's one example. Any others?
Yeah, they also talked about attracting new customers with alliance programs that offer global supplier contracts and benefits.
So you're forming strategic partnerships to expand your reach and tap into new markets.
Exactly.
So we've got these two complementary approaches. Inorganic growth through M&A, organic growth through internal expansion and strategic alliances.
Right.
And it seems like the key takeaway here is that downturns don't have to be a time of retrenchment and stagnation.
Yeah.
They can be a time of opportunity for growth and transformation.
Yes. But you need to be proactive.
And strategic.
And strategic in your approach.
Well, I think we've covered a lot of ground today, from the counterintuitive idea that downturns can be a prime time to acquire, to the importance of becoming an advantaged acquirer, to the crucial role of synergy, capture diligence in ensuring a successful integration.
Absolutely.
And I think there's a real opportunity for businesses like ours to not just survive this current economic uncertainty, but to actually thrive and emerge even stronger.
I agree. Downturns can be daunting, but they also present unique opportunities.
Absolutely. Now, before we wrap up this part of our deep dives, I know our listeners are always eager for those actionable takeaways. So what are 3 key things that they can do to apply these insights to their own businesses?
So number 1, challenge your assumptions.
Don't automatically shy away from M&A during downturns. The data and case studies we've explored clearly show that there can be significant upside potential. But you need to be strategic and disciplined in your approach.
Number 2.
Develop a clear M&A strategy.
Got it.
Define your criteria. Prioritize your pathways and create a watch list of potential targets.
Don't just wait for deals to come to you.
Exactly. Be proactive.
Be proactive.
In identifying opportunities that align with your long-term goals.
And number 3.
Dig deeper into potential synergies. Go beyond high-level assumptions. Get granular with your operational due diligence. Use that synergy capture diligence framework we discussed to identify and quantify those cost-saving opportunities and make sure you have a solid plan to execute on them.
Excellent advice.
Thank you.
So listeners, remember, downturns can be a time of great opportunity.
Yes.
But you need to be prepared to seize those opportunities. Challenge your assumptions. Develop a clear strategy and dig deep into those potential synergies. I agree.
And join us next time as we continue our deep dive into M&A strategies for businesses like yours.
Sounds good. Welcome back to the Deep Dive. Last time we were talking about how downturns can actually be a prime time to acquire other businesses, especially for those in the $2 to $50 million range.
Right. We talked about how, economic conditions create some unique buying opportunities. But I think for a lot of our listeners, the question is, okay, that's interesting, but where do I even begin looking for these deals?
Well, it's all about being strategic and knowing where to look.
Okay.
One smart strategy is to keep an eye on industries that are particularly sensitive to economic cycles.
Okay.
The ones that experience the most volatility during downturns.
Okay. So which industries tend to be the most affected?
Well, the report highlights a few like mining, energy, retail, and hospitality.
Okay.
These industries are heavily influenced by factors like consumer spending, commodity prices, global trade flows.
Right.
All of which get disrupted during economic downturns.
Right. It makes sense that when people are tightening their belts, they're probably less likely to book that luxury vacation.
Exactly.
Or splurge on a new car.
Right. Those big ticket purchases tend to be the first to go when the economy takes a dip.
So let's say I've zeroed in on a couple of industries that look promising. What's the next step? How do I actually find those specific companies that might be good acquisition targets?
Well, one approach is to start by looking at companies that are publicly traded.
Okay.
Their financial information is easy to find. You can get a quick sense of their performance and valuation.
Right.
And during a downturn, you might see some companies whose stock prices have taken a hit,
Yeah.
even if their underlying business is still solid.
So you're looking for those companies that might be temporarily undervalued by the market because of the overall economic gloom.
Exactly.
Kind of like those clearance sales we were talking about earlier.
Exactly. It's a bit of contrarian thinking. You're going against the grain, looking for those diamonds in the rough that everyone else is overlooking.
Interesting. Okay.
Downturns can create a kind of herd mentality among investors.
Yeah.
Where everyone's selling off assets, even those that are still fundamentally sound.
So there's a real opportunity there for those who are willing to do their homework.
Yes.
And think strategically.
Absolutely.
Another strategy the report mentions is to focus on companies that have a strong track record of performance even during previous downturns.
Right. These companies have proven their resilience and adaptability, which are gold in any acquisition target.
So you're looking for those companies that have weathered the storms before and come out stronger.
Exactly. And their management teams are likely to be more experienced and battle-tested.
Right, which can be invaluable during a downturn.
Absolutely.
Now, I imagine there's more to finding these hidden gems than just looking at financials and track records.
Right.
What about networking?
Networking is absolutely crucial.
Okay.
Talk to your industry, contacts your advisors, your investors, anyone who might have insights into companies that are struggling or looking for a strategic partner.
So you're leveraging your network, putting out feelers, seeing what opportunities might be out there under the radar.
Exactly. And don't forget about industry conferences and trade shows. Yeah. Even in a downturn, people are still making deals. And these events can be a hub for those conversations.
Okay, so it's a chance to make connections, get a sense of the market sentiment, and maybe even hear about some opportunities that haven't been widely publicized.
Precisely. It's all about being proactive and staying engaged in your industry, even when things are tough.
Okay, so let's say I've identified a few potential targets. What's the next step? How do I actually approach them?
Well, it requires sensitivity and tact.
Okay.
The first rule of thumb is to be respectful and discreet.
Okay.
Remember, these companies are likely going through a difficult time.
Right.
So you want to approach them as a potential partner, not a predator.
Right. You're not swooping in like a vulture.
Right.
You're coming to them with a genuine desire to help them navigate these challenging times.
Exactly. And it's crucial to do your homework before you reach out.
Okay.
Thoroughly research the target company, the financials, their operations, their market position. The more you know going in, the more credible you'll appear.
So you're demonstrating that you're serious, that you understand their business, and that you're not just making a lowball offer out of the blue.
Right.
Okay.
When you do reach out, be clear about your intentions.
Okay.
Explain why you're interested, how the combination could create value for both companies, and what your vision is for the future.
So you're painting a clear picture of the potential benefits of a partnership.
Exactly.
Not just focusing on the financial aspects of the deal.
Right. And be prepared to be flexible.
Okay.
Downturns often require creative deal structures and financing arrangements.
Right.
So be willing to explore different options and find solutions that work for both parties.
So it might not be a traditional acquisition.
It might not be, no.
It could be a merger, a joint venture, some other type of strategic partnership.
Exactly.
Okay, so we've talked about how to find potential targets, how to approach them, and the importance of being respectful, discreet, and flexible.
Right.
What else should you keep in mind when making an acquisition during a downturn?
Well, one thing is that due diligence becomes even more critical.
Okay.
You need to be extra thorough in your assessment of the target company's financial health, their operations, their customer relationships, their legal and regulatory compliance, everything.
Right, because downturns can expose hidden weaknesses that might not be apparent in a booming market.
Exactly. You're stress testing their business to make sure it can withstand the pressure.
So what are some of the specific things you should be looking at during due diligence?
We'll dig deep into their financial projections.
Okay.
And stress test those projections under different economic scenarios. Make sure their assumptions are realistic and that they have a solid plan to navigate the downturn.
Okay, so you're doing a worst-case scenario analysis to make sure they can survive even if things get even worse.
Right. And what about their customer base?
Okay. Yeah, that's a good point. How do you assess the loyalty of their customers during a downturn?
You need to understand how their customers might behave when things get tough.
Right.
Are they likely to stick around, or will they start looking for cheaper alternatives?
Yeah.
Customer churn can be a killer during a downturn.
If you're acquiring a company that's losing customers left and right, you're inheriting a problem, not a solution.
Yeah, exactly.
So you need to look beyond the financials and really understand the dynamics of their customer relationships.
Absolutely. And another important consideration is culture.
Culture. Okay.
How well do the two companies' cultures align?
Right.
Are there any potential clashes that could create problems down the road?
Yeah. Culture clashes can derail even the best-laid M&A plans.
They can.
And it's important to remember that downturns can amplify those differences as people become more stressed and anxious.
Right. People tend to be more sensitive and on edge during tough times.
Yeah.
So cultural differences can become even more pronounced.
Okay. So how do you assess cultural fit during due diligence?
Well, do your homework on the target company's culture, their leadership style, their communication patterns, their values, everything that could impact the integration process.
So due diligence is even more critical during a downturn.
Absolutely.
What about integration? Does that process change at all when you're acquiring a company during a challenging economic period?
Integration is always a delicate process, but it can be especially tricky during a downturn.
Okay.
People are already stressed and uncertain, and the added disruption of an acquisition can really exacerbate those feelings.
Right. So it's about being extra sensitive to the human element of the integration process.
Exactly.
So how do you approach integration in a way that minimizes disruption and anxiety?
Communication is key.
Okay.
You need to communicate clearly and frequently throughout the process. Keep employees informed about what's happening, what the timeline is, and what the implications are for their roles and responsibilities.
So you're minimizing uncertainty and anxiety by providing as much information as possible as early as possible. Transparency and openness are crucial.
Absolutely. And be prepared to make tough decisions.
Okay.
Downturns often require restructuring and layoffs. Right. So be honest and transparent with employees about those decisions and provide them with the support they need to transition.
So it's about being compassionate, but also decisive.
Yes.
You can't sugarcoat the reality of the situation, but you can provide support and resources to help people through the transition.
Exactly. Any other advice for navigating the integration process during a downturn?
Yeah. What else should we be thinking about?
Don't try to do too much too soon.
Okay.
Focus on the most critical aspects of the integration process first, and then gradually phase in other changes as the combined company stabilizes.
So it's about prioritizing, taking a phased approach.
Yes.
And not overwhelming people with too many changes at once.
Yeah. Exactly. And I think that's a good principle to apply to any M&A process, whether it's during a downturn or a boom time.
Right.
Don't try to boil the ocean.
Great advice. We've talked about the counterintuitive idea that downturns can be a prime time to acquire.
Right.
We've explored how to find and approach potential targets. We've emphasized the importance of thorough due diligence and sensitive integration. And we've touched on the unique challenges and opportunities of making an acquisition during a challenging economic period.
There's a lot to think about.
It is. But I feel like there's one piece missing. We talked earlier about putting together a team.
Yes.
Let's dig into that a little more.
Absolutely. We can't forget about the importance of having the right team in place to execute the transaction and manage the integration process.
Okay.
That's what we'll explore when we return for part 3 of our deep dive.
Welcome back to the deep dive. We're wrapping up our exploration of M&A strategies for businesses in that $2 to $50 million range. And last time...
Yeah, we left off talking about...
the team.
Yeah.
Building the right team.
The right team, absolutely.
Yeah, to handle an acquisition.
You got to have the right people in place to make this work.
So let's talk about that team. Who are the key players that you need on your side when you're thinking about acquiring another business?
Well, first and foremost, you need a strong internal team.
Okay.
That really understands your business, your goals, and your risk tolerance.
Got it.
This team should include people from key areas like finance operations, legal, HR.
So you're saying M&A isn't just a finance function?
No, it's a cross-functional initiative.
Okay.
It touches every part of your business.
So you need to have those different perspectives.
Exactly. And this internal team should be led by someone with strong leadership skills, a deep understanding of M&A, and the ability to manage complex projects.
So somebody to kind of call the plays and make sure everyone is moving in the right direction.
Exactly. Now, in addition to your internal team, you'll also need to assemble a team of external advisors who can provide specialized expertise in areas like valuation, due diligence, legal, tax.
So you've got your internal team, you've got your external advisors.
Right.
What are some of the key roles and responsibilities within this M&A dream team?
So on the internal side, you'll need someone to lead the financial analysis.
Okay.
So evaluating the target company's financials, developing valuation models, structuring the deal.
Okay, so that's your finance expert.
Right. You'll also need someone to lead the operational due diligence.
Okay.
Assessing the target company's operations, identifying potential synergies, developing the integration plan.
So that's your operations expert.
Exactly.
What about the legal side of things?
You'll definitely need a legal expert to handle the legal aspects of the transaction.
Okay.
Drafting and negotiating contracts, conducting legal due diligence, making sure you comply with all applicable laws and regulations.
Maybe HR.
On the HR side, you'll need someone to manage the people aspects of the integration.
Okay.
Communicating with employees, aligning compensation and benefits, addressing any cultural differences.
So it really is a multifaceted team with each member playing a really vital role.
It is now on the external advisor side.
Okay.
You'll usually want to engage an investment banker to help you identify potential targets, evaluate offers, negotiate the deal.
Got it.
You might also want to bring in a consulting firm to assist with due diligence, integration planning, and execution.
So you've got your investment banker and your consultant.
Right.
Any other external advisors that you might need on this team?
It depends on the specifics of the deal, but you might also need to engage specialized advisors such as tax advisors, environmental consultants, intellectual property lawyers.
Okay, so building this team is about assembling the right mix of internal expertise and external support.
Exactly. And remember, the size and composition of your team will depend on the size and complexity of the deal.
Right.
But regardless of the size, having the right team in place is critical for success.
It's a team sport.
It is.
And that brings us to another really crucial element of M&A.
What's that?
Communication.
Oh, yes. Communication is essential throughout the entire M&A process.
Absolutely.
Yeah.
So let's break that down. Who are the key stakeholders you need to communicate with during an M&A transaction?
Well, internally, you need to communicate with your employees, your managers, your board of directors, and potentially your shareholders, depending on the structure of the deal.
That's a lot of people.
Yeah.
What about external communication?
Externally, you'll need to communicate with the target company's management team, their employees, their board of directors, their shareholders, and potentially the media and the public.
Okay.
Depending on the size and profile of the deal.
That is a long list of people.
It is.
You must have to tailor the messaging for each of those different audiences.
Absolutely. You need to be strategic about your communication.
Yeah.
Considering the specific needs and concerns of each stakeholder group.
Okay, so what are some best practices for M&A communication?
Well, be transparent and honest.
Okay.
Don't try to sugarcoat things or hide information.
Right.
People can sense a cover-up, and it will erode trust and create anxiety.
So better to be upfront and honest, even when it's not good news.
Exactly. And be timely with your communication.
Okay.
Don't wait until the last minute to share important information.
Right.
Get ahead of the rumor mill.
So be proactive in communicating key updates and milestones.
Exactly. And be consistent in your messaging.
Okay.
Make sure everyone is on the same page and that the information being shared internally and externally is aligned.
So consistent messaging is key.
It is. And don't forget to be empathetic.
Okay.
Remember that M&A can be a very stressful time for everyone involved.
Yeah, absolutely.
So be sensitive to people's concerns and provide support to help them through the transition.
Okay, so be transparent, be timely, be consistent, and be empathetic.
Those are the 4 golden rules for effective M&A communication.
I love that.
Yeah.
No, I think we've covered just about everything there is to know about M&A strategies for businesses like yours.
We've explored some key concepts, from the importance of being opportunistic during downturns to the need for a solid integration plan to the crucial role of effective communication.
And we've seen how companies across different industries have used M&A to not just survive challenging times, but to actually thrive and come out stronger on the other side.
The key takeaway is that M&A can be a powerful tool for growth and transformation, but it's not easy.
Right.
It requires planning, execution, and adaptation.
So if you're considering an acquisition,
yes.
Do your homework.
Yes.
Assemble a strong team.
Yes.
And communicate effectively.
Absolutely.
And I think that's a great note to wrap up on.
It is.
Thanks for joining us on The Deep Dive.
It's been a pleasure.
And to our listeners, keep diving deep.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.